Okay, before I begin this week's market update, I'm going to tell you about something we're working on for September. It's beginning of July. It's never too early to start thinking about back to school. And every year we have a backpack program. We buy backpacks and we fill it with a whole bunch of really neat stuff. For kids going back to school who are in a situation where they otherwise would not be able to afford it. So we step in and pick that up. Last year we did 30 of them at $250 each, so we spent $7,500, and you see the pictures here. This is in the back of the car heading to the charity that is going to distribute them. It's heading to drop off, and this picture over here shows you some of the things that we put in there. We are raising our target this year. We'd like to get to 40, a minimum of 40, and we're raising our price, or not our price, our cost from $250 to $300, so we're going to spend up to $300. Now, when we go buy these things, since we've been doing them for a number of years, we have a number of stores in town that we get the items through that give us discounts because of what we're doing. We get significant discounts. So when we say $250, that is what I spend out of my pocket. I spend $250, but the backpack, if the person went to buy it retail, the price of everything would be somewhere between $350 and $400, only because of the discounts that we get. We have the possibility this year of getting a discount on a number of tablets. So that's why I've said, well, let's see if we can get that done without sacrificing too much of the other stuff. So my target is $12,000 minimum in getting this done. That's a minimum. Hopefully we can find more than 40 kids. You have to approach different charities that have access to children, and they would then tell you, yes, we have 6 that could use it. Here's their ages, the grades that they're in. We never actually know who the kids are or their situation, their names, or anything. All we know is what grade they're in, and that's it. And then we can tailor the backpack for the grade that they're in. When we go out to buy all this stuff, by the way, we bring high school kids with us, and with high school kids, they have to complete so many volunteer hours as part of their high school program. So they need volunteer hours anyways, and from our point of view, they're closer to the ages of the kids that we're buying for. They got a better eye. They got a better idea of what's needed and what they could use. So we bring them into the fold as well. This year we have a retailer who says these backpacks here, they're in a line of business where they can order better ones, and all we do is pay the wholesale cost, which will be lower than what we're paying retail for these ones. So every year we expand it a bit more. So here's what I'm doing this year. On the market update videos that I put out, the ones that I'm putting out on for 4 weeks in a row, July 17th, the 24th, the 31st, and August 7th. For these 4, every like that this video gets, I will add another $1. Every new sub that these videos gets, I will add another $1 as well. So starting July 17th, well, not starting July 17th, go ahead and click the like button right now. But on July 17th, the 24th, the 31st, and August 7th, when I put the new ones up on Sunday, make sure you click like, even if you don't like me or you don't like what I have to say. You can't not like this. Go ahead and click like, and it's going to cost me $1. That means you click that like button, I got to go and give $1. And if you're not a subscriber and you do want to subscribe, wait till these videos. Subscribe while you're watching these videos. Hit the subscribe button because YouTube breaks it down. It tells me how many subscribers I got on that video. I will then donate another $1. So you could cost me up to $8. It's your way of donating $8 is making me pay $8 because you could click like 4 times. Sorry, $5. You could click like 4 times, but you can only subscribe once. It'll cost me $5. Second, on each of these videos, every video I have is monetized. All of the income, all of the ad revenue generated from these videos will go towards this program as well. Normally, a video will get about 400 likes and usually about 60 subs per video. So normally this would be close to $2,000 anyways. I'd like to get the difference up there, make me pay that difference, and make me pay even more. But I would like to get to 12,000 minimum. This is not costing you anything. You're just clicking, and by clicking, you're forcing me to pay, which is what we want. You can get these numbers higher if you just share it with your community and say, hey, listen, if you just go to this video and just click like, you don't even have to watch this guy. Click like and subscribe, and $2 will go towards a backpack program. Also on these videos, there'll be, sometimes you're watching a video and there's a donate button there because it's, sponsoring a charity. We're going to, right now, it's BBBS, Big Brothers Big Sisters Niagara is not listed in the possible charities that we can put in, but we can request it and then they would add it, and there'll be a fundraising button so you can donate $2, $3, $4. Nice thing about this through YouTube is YouTube takes no cut. 100% of all the money raised goes directly to the charity. They take zero cut in doing that at all. So this hopefully will be live on these 4 buttons as well. And hopefully, if this works out really well, instead of 40, maybe we can get to 50 backpacks if we have enough target kids that need it. So, okay, let's head right in here. I think the theme for the next month or so is going to be a battle between recession data versus inflation data. Last couple of weeks, most of the indicators are pointing to an impending recession, and being that the Fed is backing the inflation path with higher rates, I'm in the recession camp as well, with a very high probability of recession, 100%, as long as they stay on this inflation path. And over the past couple of weeks, I've seen on Bloomberg different companies and different analysts raising their probability of a recession. So that's basically going to be the theme of this week as well. We're going to look at the competing factors, and it is a race right now. So the question is, will inflation roll over fast enough for the Fed to jump over to the recession camp and start lowering rates? Or will we head into a recession faster than the Fed can crush inflation, thereby giving us an even worse recession because the Fed will not be cutting into that recession, but raising rates into a recession, which is a very odd situation to be in. So let's look at what happened to rates over the course of the week. And again, the year-to-date highs are across the top. The big one to watch is the 10-year. It hit 3.49 on June 14th. And the question is that the high for the year? If you had to sort of forecast, would you be saying that the high for the year is in and that's it? We're not going to exceed that. If we're going to exceed that, that means the low for the market is not in. You can think about it that way. Money market rates have all increased except for the 1 year. All of them have increased. So you have the short end of the curve rising, and the long end of the curve has all decreased in rates, which is the right direction really, but what it's creating is a very flat curve. Look at the 1 year, 279. Go all the way out to the 10-year here, 2.88. That is very, very flat across here. The 2 to 10 has a slope of 4 basis points. Now, there is some talk about, well, it already inverted. Well, an inversion of 3 basis points for 1 day is not an inverted yield curve. That's really just volatility in rates. I don't think that was intentional. So I'm not thinking that last inversion was an inversion. Typically, when a yield curve inverts ahead of a recession, it's for several weeks at a time. 3 weeks to 4 weeks at a time, and it's significant in the basis points that it has, not just 2 or 3 basis points, and not just for a couple of hours on a given day. Or for 1 day or overnight, but it's significant. So I wouldn't say that we've inverted yet. However, given the upcoming Fed meeting and the very real possibility that they're going to go 75 basis points at the end of July. By the end of July, depending on how earnings go, you could have, well, actually it wouldn't be there. The short end of the curve will come up higher. You'll have something that may look like this, and that may stay for a period of time. This is not good for banks either. The 3-month to the 5-year, 3-month to the 10-year have in the past week have dropped 30 basis points and 25 basis points at 115 basis points each. Here was the beginning of the year. On the 3 to the 10, you're 40 basis points lower on the 3 to the 10. This will slow down lending, and whenever there is lending, it will be to high credit quality customers. And we can see a little bit of this slower lending happening if we look at the Fed's reverse repos. This is banks that have excess money saying, well, where do we put all this money for one night? And since every bank has excess money, no bank wants to say, I'll take it. Well, you have excess money when you're not building assets. You have to do something with that money. You need an asset. So they go to the bank, they go to the Federal Reserve and say, can we get some treasuries for this money because we need an asset? And as this flattens out, that'll be used more and more. By the way, this stat was on Bloomberg. Worst first half for the 10-year since 1788. Worst first half, meaning in terms of the percentage of value lost if you were long the 10-year at the beginning of the year till now. Not the worst in terms of the amount of basis points it's moved. It did start from a low base, and from the beginning of the year it's only moved 125 basis points. So at the beginning of the year it was 1.63. It's 2.88, or it ended at the end of June at 2.88. Well, this is July 1st, but close enough. Worst first half since 1788. And for equities, I believe they said this was the worst first half for equities since 1962. There really was no place to hide, was there? So if we're looking at, well, what would be a good sign to move back into equities? The Fed model is got a loyal following, and there are people who make decisions based on the Fed model. You can critique it. The easy critiques are you're comparing a nominal yield to a real value, which is a dividend yield. You're comparing a basically risk-free yield to a risky yield. However, there are market participants that think that there is something there. There have been academic papers written on this, some finding support, some not finding support, which is pretty common in any social sciences. It's pretty much evenly split. So let's take the 10-year yield, 2.88, minus the S&P yield, 1.71%, 117 basis points. And there is a belief that you're not going to really see a bottom in the market until these two things are equal, or you're not going to see a top in bonds until these two things are equal. Typically, there is some validity in that, because when you have a recession, stock prices do fall. The P falls. And when the price falls, the dividend yield tends to rise. But you also have a central bank that is cutting interest rates. And as interest rates get cut, the yield on the 10-year starts to drop. So when you have the yield on the S&P increasing while the yield on the 10-year is dropping because the 10-year price is increasing, when they equate each other, there is a belief that, well, now I may as well go into equities because I'm going to get the same cash yield on my holdings plus some upside potential which bonds won't give me. So it is worth looking at that. At 117 basis points, that would suggest that we're not there yet. So we would have to see the 10-year rally and the 10-year yield go from 2.88 back to where it was at the beginning of the year, 1.63, and that makes the market look really attractive. Well, that's not going to happen as long as inflation is walking around the streets. So forget that. The other option is that the P has to drop more. What we've had over the last couple of weeks is the long end of the curve, especially at the 10-year here, is rates dropping. We've gone from June 14th, 3.49, and just, 15 days later, we're at 2.88. That's a big move downwards. So equity markets have been kind of well behaved since that point. Well behaved in the sense that we're not plunging to 35 and 34. But if this turns around and starts heading back up to 3.49, you can expect the market to turn around and start heading down. The catalyst for that may be earnings. And that starts not this week coming up, but next week it really starts. And by the time the Fed meets, it will have a bunch of earnings behind it. It will have another CPI number behind it. And we'll see who's winning at that point. But we are heading in a recession direction. The Fed balance sheet, I introduced that last week. Notice that treasuries were heading in the right direction, but mortgage-backed securities were not. Well, in the last week, that sort of turned around. The SOMA, which is what the Fed is holding, and this is when they say balance sheet runoff, this is what they're particularly running off. Treasuries increased by $9.3 billion. They were supposed to drop by $35 billion. They increased by $9.3 billion. And mortgage-backed securities, both residential and commercial, because they have both. Not a lot on commercial. The bigger amount they have is residential, but they do have some commercial holdings. Dropped 1.9. So the balance sheet increased $7.5 billion over the month of June, and it was supposed to drop by $52.5 billion. 35 here and 17.5 here. So we're about $60 billion in the wrong direction. So I don't know what's going on there. I don't know enough about how the Fed manages the assets on its balance sheet and what obligations it might have already committed to make some kind of statement about that. But it just seems to me this was the easiest one to look at, U.S. Treasuries, and it actually increased by $9.3 billion as opposed to dropping by $35 billion. That's just completely the wrong direction. So I will wait for July and I'll see what's going on over the month of July. But if we're seeing the same thing for June and July, we have to ask the question, is this just something they say, or are they actually doing it? Here are our real yields. June 14th, still holding the highs for all the real yields. The 5, the 7, the 10 have dropped over the course of the week. The 20 and the 30 have increased. Nothing too exciting to see here. The break-even rates, pretty interesting stuff. Look at the drop week over week on the 5-year break-even rates. Big drops. And if you look at the 5-year forward, we're now at 2.08. Beginning of the year, it was 2.25. This is all recession direction indicators. The belief is that, well, the Fed's going to keep raising rates, number one. That's going to do something to inflation. But a lot of the data are now indicating that growth is significantly slowing down and that a recession looks almost inevitable at this point unless the Fed changes camp and gets out of the inflation camp and comes over to the recession camp. But as long as it stays in the inflation camp, a recession is all but inevitable. And the biggest killer of inflation is a recession. It's the fastest way to get there. Look at these inflation expectations coming out, and that is primarily because the recession is not going to get any help from the Fed. We're going to drive ourselves into a recession, and we will not have a central bank saying we'll soften the blow. Mortgage rates, interesting, 5.5. That's a 3-week low. It was 5.85 last week, sitting at 5.5. Pending home sales, down 13.6% year over year. This is a leading indicator for actual home sales, is the pending home sales. And I'll explain pending home sales in a few screens. Month over month, it's up 0.7, but it's seasonal, and we're going into the buying season. Once you get out of May, June, and into July and August, it starts to die down, and it really hollows out around November, December, and I think January is the low. House price index. We have two house price indexes that we saw last week. We have the FHFA house price index. This is the average price of single family homes with mortgages guaranteed by Freddie or Fannie, up 18.8% year over year. Month over month, up 1.6. This is for April. We have to be careful here because this is you need a transaction to get a house price. And transactions happen usually 30, 60 to 90 days after the offer has been accepted. Once the offer is accepted, you have a pending home sale, but you don't actually have a final home sale till it's sold. The reason the pending home sale is not counted is because some of those never make it to closing. So only final transactions are in there. So this April, this increase month over month is really, if you go back 2 months to February, it's actually measuring a February pending, a February offer accepted price over a January accepted offer price. If you think about it that way, because of the lag, 1.6. Case-Shiller up 21.2% year over year, month over month up 2.3. It's a 20-city composite index, so it's the change in residential house prices in 20 metro regions. These are houses that have mortgages that are guaranteed by Freddie and Fannie, and these are concentrated in 20 metro areas. They would have higher pricing, and they'd probably be more likely to have a more affluent buyer. 21.2%. year over year. So again, this is lagging. It's backwards looking, right? Mortgage applications. This is more of a coincident indicator. June 24th, for the week ending June 24th, up 0.7%. This is a number of weeks now it's been up. Refis are up 1.88%. Purchases are up only 0.12%. Refi is down significantly since the beginning of the year. And the refi market is the major driver of mortgage market layoffs. And we'll look at a site in a second that tracks layoffs in the mortgage market just to see what's going on there. But the refi index is just basically fallen off a cliff, which is typical. When interest rates go up, refinances drop. And when refinances drop, you don't need that many people in your mortgage department. So off they go. All right, this link is in the description box. A long list of mortgage layoffs, mergers, and closures. And it starts down here. List last updated June 30th. And it's not just layoffs, but mergers and all that kind of thing. It talks about who acquires whom. But we'll look for the layoffs here. First Guarantee Mortgage, 428 jobs gone. Chase, 1,000. Jobs gone. Notarized, 25% of their staff are gone. This was on the 15th. Compass, 10% of its workforce on the 14th. Redfin, 500 jobs on the 14th. What else? Wyndham Mortgage, Capital Mortgage, 48 jobs in Charlotte, North Carolina. 74 employees here, 44 employees here, 35 here. So the list goes on and on. You can look at it yourself. The link again is in the description box. So some data from Realtor.com. June is over, so it compiled its report for the month of June, and of course it does this every week. It gives us this data. Median listing prices week ending June 25th, from the 18th to the 25th. This is year over year, 16.9% higher, is now only 15.7% higher. That's going in the right direction. New listings increased by 5%. Active listings increased by 25% for the week ending. This is year over year. Last week it was 21% year over year. The week before 17%. Year to date still -9, but 17 to 21 to 25. The listings are coming. Time on the market, 4 days faster last week. Now it's only 3 days faster. So it's slowing down. Once we get to 0, it means, well, it's selling at the same speed it sold last year. And then once you start getting to 1 day slower, then that starts to really show that the market is slowing down. But 4 days faster to 3 days faster, that is slower. It is going in the right direction. If we're thinking that, well, if we can get home pricing to come down, you can cool off the housing market, you can start to pull some of that out of inflation. This is active listing count. By the way, this 25, the increase that we had for the month of June, not just week over week, but for the month of June, is the largest month-over-month increase in the data series. You had May over here. This is where we are now. Putting things in perspective, right? The green line here is 2021. This yellow line is 2022 for the number of active listings. You still have a long way to go to get above 2017 to 2019 region. But some interesting stuff going on here. This is the price reduced share. How many people have reduced their price while the listing was live. This is a leading indicator for home price indexes. Look at this big jump. Look at that. That's going in the right direction. This is 2021 down here. This is 2020. The yellow line is 2022. Then you have 19, 17, and 18. But that's a big jump. So prices are coming down. This is the listing price that's coming down over the month of June. Huge drops. This is the share was 14.9%. That's a 7.3% increase year over year. 14.9% of listings had a price reduction. Let's take a closer look at the pending home sales. We had that report earlier last week. This is from the National Association of Realtors. Their index sits at 99.9. Month over month, the pending, we had already reported this pending was up 0.7%, but down 13.6 year over year. And it tells you down here an index above 100 coincides with a higher level of activity relative to 2001. 2001 is 100. So just looking at this chart here, the West, 81.6. Look at that month over month, down 5%. So relative to 2001, you only have about 81% of the activity going on versus what you had 21 years ago. And the Northeast, 86.7, whereas the Midwest, 98.6, down 1.7%, and the South, 119. Lots of activity going on in the South. This is the pending, this is from Realtor.com, pending listing count. Look at it rolling over. Pending means that you've got your house listed, you've accepted an offer, but from the time you accept the offer, there's a bunch of things that happen. It doesn't close right away. Sometimes the closing is 30, 60, 90 days away. It doesn't become a home sale until the transaction is done. So a pending sale is not a home sale. It's just a pending sale, which makes it a leading indicator. If the house closes 60 days later, it becomes a home sale 60 days later. But the price paid 60 days later was the price this month, not the price in 60 days, which makes a house price series kind of a lagging indicator, 30 to 60 days lagging. So I got a little timeline on the bottom, and I've highlighted, let's say that this is May in here. This is the month of May. Home sales that are registered for the month of May happen back here. They were pending sales back in February, March, and April that finally closed during the month of May. So the price of the homes that we see in the month of May were actually the prices of the homes earlier in the time series. And the activity that you see in May was actually the activity that you saw back here. It's very rare that somebody buys a house and closes within 24 or 48 hours. It's very rare. The majority of houses are 30 to 60 days. In fact, about 80% of houses are somewhere between 30 and 60 days. So in May, let's say you have a bunch of offers that are accepted. Well, those are pending home sales. That's a leading indicator. They will show up as home sales in June, July, or August. Then they become transactions. So they will show up in existing home sales and in house price indexes. But when we look at a home price index in June, let's say, that is based on prices that were negotiated in either March, April, or May, not necessarily reflecting what the price of the house is in June. For that, you want to look at Realtor.com and get what the median listing price is, what the share of, combine it with the share of houses that have seen price decreases. And you have to sort of use, mosaic theory and put all that together because of these lags. But if we're looking at what the future looks like, pending home sales is what we want to look at. Look at it rolling over. Up here, this is 2021. This other line here is 2020 as we expect. And down here, you could say this is normal activity here. Well, we're rolling over on that one as well. So we're seeing that houses are selling slower. Active listings are really increasing. In fact, largest month-over-month increase in the series that Realtor.com has happened for the month of June. And the share with price reductions are really increasing, and the pending listing count is rolling over. Question is it going to roll over fast enough to show up in the price series to affect inflation? Because when we get inflation this month, July, we'll get it for the month of June. But we know that the home prices that we're going to see in the month of June were going to be influenced by what the prices were in March to some degree, but heavily April and May. Is it going to fall fast enough to make a difference in the inflation number to pull the Fed off of that path and maybe get it to pull back and say, well, maybe we don't need 75 this month, maybe 50, and then maybe we could drop to 25. That would do a lot to curb the recession anxiety that I think is pretty dominant right now. Okay, let's look at the PCE report from last week. Here is our chart. Disposable personal income in current dollars, that's nominal, up 0.5% in May. This is a percent change from preceding month, up 0.5% in May from April, but on a real basis, controlling for inflation, negative 0.1. For personal consumption expenditure, current dollars, which is nominal, 0.2. Look at the drop we've had here. March 1.2 down to April 0.6, now 0.2. If you control for inflation, if you look at it in real, that's price times quantity, taking out the price and just looking at the quantity, negative 0.4%. That's not good. That's fewer things being purchased. Even though they're being purchased at a higher price, there's fewer things being purchased. 0.2% in current dollars. Price indexes, PCE excluding food and energy, 0.3, and it's been 0.3 for a while. It's basically been flat. If we look at it year over year, we can see it being that this is flat. The only way this can go down is due to base effects. PCE excluding food and energy from February 5.3 down to 5.2, down to 4.9, down to 4.7. It's going in the right direction, but dropping by 20, 30 basis points a month. If we drop that by even 0.3, you've got to get from 4.7 down to 2. It would take 9 months to get there. 9 months of the Fed, being in the inflation camp. I don't know if they'd be in the inflation camp all the way down to 2. I think at some point they'd start to, pay attention to the recession. But from where we are right now, doesn't look that way. Things are going in the right direction, except right here. This is not going in the right direction. If this can moderate from 0.3 to 0.2, that starts to be a little bit more promising. This, if it's 0.3 per month, that implies an annual inflation rate of about 3.6, 3.7%. Still lower than the 4.7, but something is sticky in here. Something is just not budging in here. This is just base effects. This would be expected, but base effects will run down until it equals an annualized rate that we're seeing here. If this stays at 0.3, which means you can expect 4.7 to drop off due to base effects down to 3.6 to 3.7, but something in here is an issue. This is month over month, not year over year, right? This is month over month. Let's look at some other highlights here. 32.7 billion increase in current dollar PCE in May, that's nominal spending, reflected an increase of 76.2 billion in spending for services that was partly offset by a decrease of $43.5 billion in spending for goods. So for services, within services, increase in housing and utilities, other services led by international travel, and healthcare led by hospitals were the largest contributors. Well, that's nothing to get excited about. You're paying more for your healthcare and you're paying more for your housing and your utilities. I don't know that that's anything to get excited about, getting an increase in services spending from that. Within goods, a decrease in spending on motor vehicles and parts, led by new motor vehicles, was partly offset by an increase in gasoline and other energy goods. Well, that increase, I don't know that that's any good either. And this decrease in motor vehicles and parts, led by new motor vehicles, is not because demand dropped off and inventories are building across dealerships. It's because automakers simply can't deliver the vehicles. At 8:45 on Friday morning, my system beeped, one of those lower beeps, not the higher beep, meaning that a trade has been made, but a lower beep, meaning there's something going on. I looked up and it said the market data halted. So it only says that if it's something that you already hold. So, okay, well, let's get up and walk over there and see what's going on. I look, it's GM halted, which caused a couple of strokes and a mini heart attack. I calmed down and went looking for the information because it's never good. It's never good when they halt it. They don't halt it to say, hey, things are going great, by the way. It's always something. So I couldn't find anything other than California had gone ahead with a lithium tax, which is going to affect some of the lithium mining at the Salton Sea. And I thought, well, is there something negative there? Because if there is, that's really nothing to get worried about. And then Bloomberg started talking about it. Oh, GM is halted. There's no news. What could it be? Big. It's going to be big. It's, oh, come on, man. And it's just an update for Q2, which, you know what? I expected that there to be something. And the big thing was it was lowered guidance for Q2, but they still maintained the full year, which is why they still had a positive day on Friday. They sold off out of the open, but came right back up. The big part was 95,000 vehicles parked in a parking lot with missing parts because they just don't have the parts to complete them. So they built what they could build and then they parked them. So GM's not alone in not being able to deliver vehicles. So this drop that I've got highlighted in purple, in blue here, decrease in spending on motor vehicles and parts led by new motor vehicles. That decrease in spending, I don't think was intentional. I think it was just, well, look, you can't buy it. We can't deliver it. You can't get it. So it can't be a transaction. It's going to show up in future months. It's not that it's gone for good. It'll just show up in future months. So it's still messy. It's still not clean in the sense that we're getting a true pulse of the consumer on this one in terms of the spending. It's driven more by some inflationary pressure, housing and utilities, and some lack of supply, specifically new motor vehicles. One of the tables I highlighted, let's go to that one. Table 2, I think it was. Let's see. Nope. There it is, table 5, personal income and its disposition. Particularly down here, personal consumption expenditure, they break it down in goods in terms of durable and non-durable and services. Let's go all the way to the end. So goods up 0.2% in May. Seasonally adjusted at monthly rates. Look at this number here, the next two. For goods as a category, down 0.7. Durable goods down 3.2. Non-durables up 0.7. Non-durable goods are the largest or the biggest interest rate sensitive component of consumer spending in these categories. Negative 3.2 and services 0.7. So I thought I'd point that out. The data we just looked at was for the month of May. We don't have any June figures yet, But let's just look at what happened to prices over that period of time. When we look at CPI and we look at PCE, by the time we get them, they're rear view mirror. And to sort of assess where inflation is today, what is it today? You have to say, well, look, what has happened since the time period when you looked at those prices and now? So let's look at some big commodities that are inputs to a lot of things. Here we'll look at corn, soybean, and wheat. These are the three big grains. And I've got May blocked off on each of these charts. Down here is cotton. And I've got June. So you can look at where the average prices were in May versus the average prices in June. And from the end of May to the end of June, corn is now down 7.9%. So this is going to be seen on a going forward basis, but the numbers that we get for CPI for May were these numbers here. In July, the numbers we're going to get are for June. This price may continue to drop, but we're not going to see that till later on. Soybean, not much here. If you think about average price throughout May versus average price throughout June, if you tried to do an average, it's probably about the same. However, from the end of May to the end of June, soybean is now down 7.2%. Wheat, even more. Look at the average price in May up here, whereas the average price in June is somewhere down here. 23.3% drop from the end of May to the end of June in wheat. This is not going to show up in any data yet. Cotton, huge price drop in cotton. Here is May up here, so if we looked for an average, maybe somewhere in here, whereas for June, your average has got to be somewhere in here, significantly lower. End of May to the end of June, cotton has dropped 16.7%. So we do have, this is all deflationary, by the way. This is all deflationary. We do have signs in the background that inflation is coming out of these prices. Now, these prices are still elevated from, this is a 6-month chart. This is beginning of the year. Still elevated from the beginning of the year, but when you look at where the panic was in inflation in this region up here, this is where these prices have shown up in inflation already, all up here. We are below all these panic levels in inflation. They are coming down. Some of it because the supply channel is resolving itself in places. Other places because, well, with the recession coming up, there's a belief that these prices aren't going to hold. That's probably more true for cotton than it is for the grains. Okay, copper. Look at copper, down 17%. That is a leading indicator. Still elevated. If you look at, let's say, a 5-year price chart of copper, it's still fairly high. But when you had 480, 490 up there, and you're down under 370 at this point. So average prices for copper in May, somewhere in here. For June, somewhere down here. Aluminum, look how much it's come down from the peak way back here. This is May and this is June, down 11.3% end of June from end of May. Nickel up here, this is May. This region in here is May and this region here is June. So if you look at average prices in here versus average prices in here, it has dropped. Nickel prices are down 19.5% from the end of May to the end of June. Lumber has really come down from the peak. This was over 1100 at one point. This is May here. You can see it dropping through May with an average price somewhere in here. And in June, we've got an average price here. We are seeing some run up here in the end of June. From the end of May to the end of June, prices are up 7.5%, but the average prices throughout June versus average prices throughout May were significantly lower and much lower than it was at the beginning of the year for the first couple of months in the year. It was ridiculous pricing on lumber. So housing showing signs of slowing down. Commodity prices coming down as well. All of these are indicators of a looming recession. And we're seeing the PCE, as far as real personal consumption, the quantity bought is actually negative. Let's look at spreads, because they're an indicator as well, and they're telling a story that, yeah, recession is coming and we're getting ready for it as well. This is investment grade up here. This is high yield. June 24th last week was 155. It's 1.64. So it is up 9 basis points. This is not wow, by the way. This is week over week. I'm not saying wow, 9 basis points. I'm saying week over week. Look at high yield last week, 518 basis points, 587 basis points July 1st, up 69 basis points week over week. Year to date, up 282 basis points. It started January 3rd at 3.05. You're at 5.87. Here we started at 97 basis points. We're at 164, up 67 basis points year to date. Recession levels for investment grade, typically over 200 basis points. We're at 164 right now. So the trend is in there, right? For recession level for high yield, typically greater than 800 basis points. Typically tops out around 1,000 on high yield. That's the index, by the way, the OAS on the high yield index, not on any one credit quality. If we go into the credit qualities, this is investment grade. If we just pick on AA, January 1st it was 0.62, July 1st 0.96. That's a 50% increase in the spread. Last week it was 0.91, so even AA's, the credit spread on AA's are widening. Triple B, where are we on triple B? Started at 1.2 at the beginning of the year. Last week it was 192, now it's 204. And a triple C or lower, and this is not really where you want to be, but still, let's see what's going on here. 6.74 January 3rd is now 11.94. Last week was 11.14. There's no reason for this spread to be widening, but it is. There's no reason why these companies that have AA credit ratings would be credit riskier. But when you go into a recession, the market doesn't always pick and choose. It sort of just says, well, credit spreads are just going to widen across the board. But here are the levels that I would be looking at. 587. Watch the 800 level here, and we're at 164. Watch the 200 level on this one. Okay, earlier in the month, the conference board released the leading indicator index. This is year-over-year change in leading indicator in blue. This is year-over-year change in real GDP in gray. And you can see that it leads. You have a drop in real GDP. You have your leading indicator dropping. And then you have a rebound here. Your leading indicators really rise. It oscillates far more than changes in real GDP. So you can see that it overshoots and undershoots. Well, I say it's not really an overshoot or undershoot, just a higher oscillation in terms of percentage change. Look what's going on here. Real GDP coming straight down and leading indicators coming straight down. JP Morgan this past week revised its second quarter GDP estimate down to 1% from 2.5. That's a big drop. And revised its third quarter GDP forecast to 1%, down from 2%. And we had introduced GDP Now from the Atlanta Fed. I think about 2 months ago we introduced it in this series, and I told you there is an app that you can download that will give you alerts on your phone every time they change the GDP Now forecast. Well, it is now negative 2.1. And by the way, if you were paying attention last week, everyone's talking about GDP Now. Everyone's talking about it. So if you were with me 2 months ago or 2.5 months ago, I can't remember when we introduced it, nobody was talking about it then. Now everyone's talking about it, and you would have been way ahead of the curve because you would have said, I knew about that way back when. You're late to the game. Negative 2.1. So all of this is pointing in a recession direction. So we have two things going on. We have a race. We have a race into a recession from a lot of different indicators, but we also have a race going on in inflation coming down. in deflationary things that we see going on in the background. The question is, which one's going to win? When I say which one is going to win, I more correctly mean which one is the Fed going to side with? Inflation? If that's the case, get ready for, I think, a very hard landing and a very near-term recession. But if they hop off the inflation track and jump onto the recession track, they may slow down those rate increases. I don't expect the Fed to really make a decision about switching camps till about September. Might be a difficult 2 months, July and August. Let's look at the dollar index, DXY. This is a year-to-date up here, and this is a full series, all going back to the early 80s here. We can see a downward trend in the dollar index till just about this time period here. Then we had a sideways movement, and we've recently broken above that particular resistance level. And we have, if you look year to date, an upward sloping trend. Year to date, the dollar index is up 9.28%. That's not the US versus any one single currency. That could be, 10%, 9%. That's against a basket of currencies, so that's pretty big to happen year to date. The correlation between global real GDP growth and the US dollar is negative, meaning that the US dollar is counter-cyclical. So if global GDP growth is heading down, the US dollar is heading up. If we have an environment of robust real GDP growth globally, so that global growth is increasing, the US dollar tends to drop, whereas commodity currencies tend to be pro-cyclical. The Aussie and the CAD tend to be pro-cyclical. The Aussie pro-cyclical with real GDP global growth, but also with China growth as well, and the Canadian dollar is more tied to US real GDP growth. So if we have a turnaround in global growth, then these commodity dollars will go along. They are pro-cyclical. Then you'd see a rollover in the US dollar. It has less to do now. The US dollar strength initially had more to do with you had a central bank that was moving on rates sooner, faster, and bigger. Especially against the other big reserve currencies like the euro, the Swiss, and the yen. But now it's gone into global recession fears, so I don't expect the US dollar to really roll over hard at any point. I do expect it to probably keep its strength for a while until either the Fed jumps out of the inflation camp into the recession camp and starts lowering rates because it thinks the recession is the bigger enemy, or somehow global growth comes together and says, aha, it was all just supply driven anyways. Look at this. It's all cleared up and we're all back to normal. I don't expect that to happen. I think that we're in a holding pattern for a while until the recession becomes a bigger problem than inflation. Still, inflation could magically wisp away very quickly. That could happen. There is a possibility that could happen. Global growth could come back. That could happen. But I think that the more likely direction is more increases in rates globally by central banks. A global recession, I think, is pretty much in the cards until we get to a point of indifference where the Fed says, well, the recession is just as big a problem as inflation is right now, and maybe they want to jump camp. And then I think your US dollar or the dollar index will begin to roll over. So let's look at the Canadian dollar and the Aussie dollar. I have a long position on the Canadian, quite a large long position on the Canadian, but I'm comfortable with it because I can live with US dollars or Canadian dollars. I'm okay. So I'm okay with that one. It's bigger than I normally would, but I have US dollar exposure on GM anyway, so I look at it as, well, okay, now I'm overhedged on my US dollar, so my actual active exposure isn't really as big as my position would indicate. The Aussie dollar against the US down here, and because it's US CAD and this is Aussie US, they'll be inverse of each other. That if you held a mirror up, these are kind of mirror opposites of each other. This is the Canadian weakening, this is the Aussie weakening. There's the Aussie strengthening, there's the Canadian strengthening, there's the Canadian weakening, there's the Aussie weakening. They kind of are very highly correlated. Because they're both commodity currencies. Canadians sitting now at 1.28878. Bank of Canada is meeting on July 13th. The expectation is for a 75 basis point move. That would move us from 1.5 to 2.25. This is July 13th, 10 a.m. Eastern Time. Canadian CPI for May 2022, year over year, 7.7%. And Meldrum, who is the head of the Bank of Canada, is far more hawkish than the U.S. Central Bank. So I would say 75 basis points, barring any information coming out in the next, where are we now, the third, in the next 10 days. Any information in the next 10 days that could change his mind would have to be really big information. I don't see that happening. I think 75 basis points are in the cards. I've put an initial target on the CAD at 1.2 that I think I'm holding my position till I see that we're getting towards 1.2. We're 1.28878. I don't think 1.2 is unrealistic. These were periods where the Canadian dollar was worth more than the U.S. We were above par back in just before the crisis. This was when oil was about 150, and then after things settled out, oil was still elevated over $100. We were still doing fairly okay. The Aussie was doing really well during that period of time. Hit 110 to 111 against the U.S. That means $1 Australian was buying $1.10 U.S. It was worth more than the U.S. and have it now sitting at 68.15. So that one Australian dollar only gets 68 cents US. And I've drawn a line here at a level of resistance that it would meet first at 80 cents. Reserve Bank of Australia is meeting July 5th. That is Tuesday, or Sunday. That is Tuesday. It's the other side of the world. If you're in Australia, you don't have to change your clocks. You just have to look at your clock. But if you're over here, you have to adjust your clocks and say, well, what time is it going to happen? It happens our time, 12:30 a.m. So Monday night, once you hit midnight, stay up for another half hour, and you'll get the decision. They're expected to move 50 basis points. That would get them to 1.35. I imagine they're going to get some kind of rally off of those decisions, but I don't know, given U.S. dollar strength, that they're in a position to start their move towards 120 and towards 80 cents. I've started to build a position in the Aussie. If we look at their CPI, sorry, I didn't mention that. CPI, I only have Q1 2022 CPI information, 5.1% year over year. Softer than the Canadian data at 7.7, but 5.1% year over year, but only an expected move of 50 basis points versus 75 for the Canadian. I've begun to build a position in the Aussie dollar, but beginning, it's 10% of what I would normally do, only because I don't expect it to run there now. It's going to give me some time to build a position over time, and if I change my mind, I change my mind with only 10% of a position. It's better than taking a full position and then screaming at the screen, are you still selling off? You got to be kidding me. I've seen that done. So if you build your position in, nothing's going to really hurt you, and then you have the decision of saying, okay, well, 10% was a mistake. Let me just sit here. I'll wait. I'm fine. I still have, more longer term, going out a year to 18 months. I still think that these targets are reasonable. But I have begun to build a position because I don't know where the bottom is. You're never going to pick a bottom. The best you can do is average into it over a period of time. And who knows? things could turn around and run. Well, I'd like to at least have some kind of participation in it if it runs. So I'm not going to wait till the last minute or keep waiting and waiting. I'm going to slowly build in. I'm comfortable. It has support at 0.6770. And we're at 0.6815, so we'll see if that holds. I should also say for the Aussie dollar, if you look at the level of government debt to GDP for Australia, it is almost non-existent. It is, compared to everybody in the world, they are a poster child. They're fantastic. So let's look at some more indicators fighting recession versus inflation here. Look at this. This is from trueup.io/layoffs, and it's showing the amount of tech layoffs. It's kind of neat because they put the little logo in for all the different companies that are experiencing layoffs. This is January 2022. This, by the way, look at all this. This is the last 5 months of 2021. Look how small these numbers are. 631 to 6,300, 5,500, 57. May jumps to 20,000. June jumps to 27,000. And July, even though there's only 1 day of July, or they only have 3 days of July. This is as of July 3rd, at 108 already. But I mean, it's a long weekend, so I don't expect big numbers being announced there. But I started seeing this about 2-3 months ago, is slowly more and more tech, starting with hiring freezes, then layoffs, and it was primarily hitting tech, and then it just became a runaway. This is a recession indicator. Talk about inflation coming down. Look at this is the FBX, the container shipping index, 65.77. January 1st, it was 92.93, and this is the month of May over here. So all the way from January to May, the first quarter, you had elevated shipping rates. Then it started rolling over in May, and look what happened in June. We're all the way down here now, average in May, average in June. So from the beginning of the year, the container shipping rates are down almost 30%, 29.2%. That's disinflationary. It speaks to inflation coming out. So recession revving up, inflation coming out. Again, the Fed is in the inflation camp, right? We've got to get enough information for the Fed to jump over to the recession camp. So the recession's got to get a lot worse, or the indicators got to get a lot worse, or inflation has got to get a lot better. Some more data on a recession. U.S. manufacturing PMIs rolling over. This is 2022 over here, just rolling over. This black line here is 50. Anything above 50 is expansion. Anything below 50 is contraction in manufacturing activity. We're still above 50. However, we've gone from almost 65 down to 52, 53, which means, yeah, you had growth, but growth was slowing and slowing. So we still have growth, but it's slowly going away. This drops below 50. That was a recession. That was a recession. And look where we are right now. So there's another recession indicator. Another indicator of easing inflation. This is shippers' view of available capacity. This is from Bank of America Global Research. Available capacity increased to 70.9, up 3.9 points. More shippers see available capacity, which is bearish for shipping rates. Bearish for shipping rates is bullish for inflation. Bullish meaning we want to see lower inflation, as that being bullish, right? This is year over year. Look at the black line here. This is 2020. Look at the direction it's going in. Look at the direction that this is going in, right? As far as available capacity goes, that is fantastic. That is deflationary. So we do have signs that inflation is coming down. I've shown you lots of those, but we also have lots of signs that recession risk is increasing, and the Fed is in this camp right here. That's the switch that has to be made. When you see the Fed switch from talking down inflation to starting to pay attention to recession rolling over, Well, that's the time I think that markets really stop and turn around and begin a long rally. However, to do that, the labor market's going to be key. I don't know that the Fed is going to jump in on the recession camp if unemployment is sitting at 4.1%. Speaking of that, we get jobs data this Friday coming up. So we'll see what's going on there. We'll see if that is also leaning towards, or at least heading in the direction of a recession indicator. So how do we navigate a market that seems to be a choice between two things we don't like? One, inflation and higher interest rates on the one side, and on the other, recession and lower growth. What could you possibly do? Can't hide in bonds. What if rates keep going up? Well, bonds will crush you. Can't hide in equities because, well, what if recessions, what if the indicators keep rolling over and earnings take a hit in July? Well, prices are going to drop. But you got to be somewhere. You can't walk around saying, well, I don't want to be here, I don't want to be there because the price is falling. You just have to think about, where do I want to be if I look past this kind of thing? So let me show you what I've done with my portfolio, or I'm not done so much, but what I'm doing. Overall, at the level of the index, I'm short calls. On every rally, I sell out of the money calls, because I just don't have faith that we're getting back to 18 times forward earnings anytime soon. I don't pick a technical level, I pick a fundamental level. So I look at where the forecast for earnings are, and I don't adjust them. I say, okay, well, if that's the forecast for earnings, let's multiply it by 17 or 17 and a half, and there's a level at which I'm more than willing to sell calls. On any rally, I sell calls. I use short straddles as well, using an in-the-money call and an out-of-the-money put, so that if the price does drop, the in-the-money call pays off wonderfully, and it gives me some nice break-even points. And at some point, I'm more than willing, if my break-even is somewhere around 330, 320, I'm more than willing to hold the SPY at that level. So at the level of the index, I'm using the options to set my positions and to generate some income, so that whether the market goes up or whether the market goes down, the options at least have some positive payoff. REITs. I'm sitting in REITs. I have lots of experience with them, so I have a list of, and for me, it's got to be Canadian REITs, because in a taxable account, I have no tax treaty with the US or any other country. And since I'm sitting in REITs for the income, I don't want any withholding tax taking away my income. So if you say, well, what's a good REIT in my country? I don't know. I only know what I'm in Canada. And the types of REITs I'm in probably would be the same types of REITs you'd be in. Apartment REITs, number one. Rents are going up. They're still going up. In fact, Ontario has limited the amount of rent increase that apartments can take to 2.5%, only because rents are at such ridiculous levels right now. Occupancy levels are super high as well. So trying to find an apartment is going to be difficult. And if you expect a continued slowdown in housing, where are people going to go? Apartment REITs. Yeah, the price is taking a hit, which just means the yield is higher. Well, I'm okay with that. I'm okay with getting 7 or 8% dividend on an apartment REIT, which is what you should be getting. For a long time, it was, you had to struggle to find something at 3.5%. You should be getting a nice dividend. Retail REITs. Here, I'm looking for not so much the big malls with all the stores in them. I'm looking for more of the strip malls. Or the malls that don't have an indoor to them, but they're all you drive in, and maybe they're L-shaped or whatever, but they're kind of what you'd call a strip mall. Grocery anchored, government offices, medical or dental. These are very stable long-term tenants. So anything like that, that's great. And there's a number of them in Canada. Great dividend payers. They're just income earners. They're just little engines in your portfolio that on the 15th of every month you get your rent checks. The Canadian REITs pay monthly, and it's pretty much a standard. They pay on the 15th of each month, so on the 15th you get all your rent checks in. Office, I'm looking at selectively only in major cities, not in what are called secondary cities, but in primary cities, and I'm being selective here. The goal here is income, and I try to choose ones that have options. You're not always going to be successful. Sometimes you have a good REIT that pays a good dividend, but there's no options or very illiquid options. But if I have a choice, I'll try to get ones with options, and I'll sell calls. If I don't have enough in terms of, I've got these exposure to these REITs, but they don't seem to have options, I'll find an index that might be holding some of them, and I'll sell calls on the index, because for the index to go up, all the components have to go up. In the US, if you're looking for a REIT index, IYR is one that I think you can sell calls on, but I think everyone is selling calls on that, so there's not a lot of premium left anymore. I've looked at it a couple of times to see if I'm interested in selling calls on it. And, as soon as you go more than $2-3 up, and if you're out like maybe a month or two, the premiums just aren't worth it. So I haven't touched IYR for that purpose yet. If I am going to use US REITs, US-based REITs, I'm going to use them with synthetics. I can't buy them outright. I don't want the US dollar exposure. I don't want the withholding tax either, because with a REIT, you actually lose like 30%, not 15, but 30% of the dividend, because it's a non-qualifying dividend. And because I'm using synthetics, there are no dividends. It's all capital gains. The dividend is in the price of the options. So the put option will be inflated by the present value of the dividend, and the call option will be deflated by the present value of the dividend. So if you're using synthetic and you combine them, the premium you get is the time value of whatever time you have left. You're getting that value plus the present value of the dividend for that period of time. So if you are using another country's securities in which there's a withholding tax, if you create a synthetic position, you can avoid the currency exposure, you can avoid the withholding tax, and when you claim it in your country, you're claiming a capital gain and not a dividend. The dividend is income. That's taxed at 53% in my country for me, whereas if I can turn it into a capital gain, it's only taxed at 26.5%. So it is far more tax effective. In the middle of my portfolio, I'm adding things that I think are priced well, but I'm adding them with options. I always do everything with options when I'm building a position, because rather than buying it, I can get a lower price by picking the strike price at which I would want to buy it at, and I get the premium. And if it gets to that price, I buy it lower than anybody else in the market because I got the premium to offset the price. And if it doesn't get to that price, I made money just by saying I would buy it. What's not to like? JP Morgan, I've sold $100 puts for August. These are all 10% positions, by the way, except Bank of Nova Scotia. I'm a little bit higher than 10%. But all of these are 10% of what I'd normally buy. All of them are 10% of a position I'd normally buy. Because if they are put to me and I change my mind, oh well, it's only 10% of what I would have bought anyways. So for you, think about if you want to buy JP Morgan, say, well, I'll buy 100 shares. Buy 10 shares. Well, if they fall $2, so what? You're down $20 instead of $200. Then you have to then you have time to reconsider your decision, saying, did I make a decision that was wrong? Has new information come out that has changed my mind? Or is the market just weak and this is still a good thing to do? Then you might have another target, let's say $3-4 down, where you say, well, I'll add a little bit more there. So JP Morgan, I've added the $100 puts for August. Nike, $90 puts for August. These two have been beaten up a lot. Same with Disney, that's been beaten up a lot. I've got the 80 puts for August. I think what's going to help Disney is the new Star Wars series, which revisits Obi-Wan and Darth Vader. There's talk of a season 2. I don't have Disney Plus, but just for that alone, I would buy it for the year. Shanghai's a problem. Disney World Shanghai is a problem because I don't think China's done shutting down. I think they'll do it again. so that's a bit of an issue. But an $80 put, I think, represents a good entry on Disney. Bank of Nova Scotia, I'm long the stock and I sell calls on it to replicate the dividend. So I have on BNS, I create a 2 times dividend. So 5% yield is now a 10% yield from me. So long BNS, and I'm short the calls. And TD, which is another Canadian bank, I've sold the 84 puts for August. So you can see that I have financials in here, JP Morgan, Bank of Nova Scotia, and TD. Very strong bank here, and the Canadian banks have never stopped paying dividends. Ever, ever, ever stopped paying dividends. Great place to be, and they're not going away. And Disney and Nike, I think, are just 2 companies that aren't going anywhere either, that are priced at a good price. And finally, I have this going on in my portfolio, and I'm setting up for the next bull cycle on this one. I think over the next 10 years, you're going to have the equivalent of another industrial revolution globally. You're talking about changing the entire fleet of vehicles to electric, and every car company has jumped on. Every mining company is aware that they're going to have to increase their capacity at some point. The forecast is that by 2030, the amount of mines in the world have to double. They have to double to meet the demand that's coming. You want to electrify the grid, move away from coal, from natural gas, from oil. That requires copper. Wind, solar, tidal, all of these things require copper. Everything, as soon as you say electric, requires copper. Lots of it. So I'm planning for that. Also, you have increased fuel efficiency standards that need to be met. You don't have a phase out of internal combustion until 2035 in Europe. And 2030, 2035, 2040 in different parts of the world, but you have to meet higher and higher fuel emission standards. The easiest way to get that done is to lighten the vehicle, and that's aluminum, moving from steel to aluminum. So I'm long GM. I've recently started selling Ford puts for August. I think the $10 puts for August, because they're just so cheap right now. And I have a synthetic long on BorgWarner. In metals, I have the ETF for miners pick. I've added BHP and Rio. I've sold puts on those, and I've recently sold puts on Freeport. I think I sold the $27 August puts on Freeport. CAT, 170 puts for August. If you're going to double the amount of mines in the world over the next decade, you need machines that can move that earth. And the biggest player in that space is CAT. Not only that, in every CAT, there's about 300 to 500 pounds of copper. Crazy stuff, right? So the more CAT you buy, the more miners you should buy, and the more miners you should buy, the more copper they need, the more CATs they'll order, and you've got this nice little cycle going on. And Alcoa, they've come down from the high 80s, and they're into the 40s right now. I sold the $35 puts, and again, all of the ones that I'm selling puts on are anywhere from 10 to 15% of a full position, and I'm willing to sit on them. Because once I have them, because I have the ability to play the options, I can then sell puts lower to add the next 10%, while at the same time selling calls above to lower my risk, because I may think, well, for a period of time, we don't need the upper part of the distribution. So just to give you that in a chart form, let's say that you're looking at a price that has gone like this, and it gets put to you. Well, there's going to be some distribution. Let's go out a couple of months. The forward price always looks like this, by the way, and you'll have some kind of distribution of possible returns, because I don't think that would be going up. I'd say, okay, well, at some probability, I don't know, maybe that's a 20% probability in the tail, which is a delta of 0.2. I'd be willing to sell that call up there, and I'd probably say, okay, well, down here I'm willing to add another 10% to my position. The combination of doing all of these things ends up being super powerful. By the time you build your full position, you look at your average price and the time over which you've done it, ends up being super powerful. The unfortunate thing over the last couple of years is you couldn't really do that, because markets did not move slowly. Markets just went somewhere tomorrow. You know, if the index was at 4,000 and somebody said, well, it should be at 4,400, you think, yeah, maybe. Well, it gets to 4,400 in 3 days. You didn't have time to build a position. You either had to jump on board or that was it. And I don't play that way. So I missed a lot of good moves because I just was hesitant to take a 100% position. This is the type of market that works well for my style, which is you slowly build into a position, you use those options, you sell off the parts of the distribution you don't want, you buy the parts of the distribution other people don't want, you ignore the whole middle of the distribution. I got no loss in the middle of this distribution when I sell that put. I'm just protecting somebody else from this. And as far as currencies, the Canadian and the Aussie makes sense because it is a commodity currency. Look at all the big mining companies are located in Australia, and they export a lot. And the CAD is another commodity currency, but a lot more diversified in their commodities, from oil to the grains, all the way to the base metals. And again, since this is for the next bull cycle, I am really hoping that I have 2 to 3 quarters over which I can build these positions out. So when faced with a market like this, I think, look for something that gets you some income, something that you can generate income using the options. I think now more than ever, the options really matter because you get to pick the part of the risk distribution that you want, and then start thinking about the next bull cycle and where you want to be. You want some nice stable companies in here that are going to be winners no matter what. And you want to set up for a sector that you think is going to be a long-term bull market and really outperform the market. And I think this move to EV and this big move across a lot of countries to electrify everything is going to be the equivalent of another industrial revolution. Now, it's not just changing all the vehicles to EVs. It's all the charging stations that need to be put in place. It's autonomous vehicles. It's the amount of software that is going to go into the vehicles. And not just go into the vehicles. That's just step one. It's the amount of sensors that are going to be built into roads. They're going to be built into all the devices on the roads, into the street lights, into into the center median lanes, into intersections. Think about walking around with your smartphone. As soon as your smartphone indicates that you're outside on the street, it switches to pedestrian mode, which means it now becomes a sensor which other vehicles on the road can now sense you. They don't need to hit you with a camera or LiDAR to figure out where you are. They'll know exactly where you are by the location of your phone. All of that, the whole grid network, think about the absolute change you're going to have over the next 10 years. This is the equivalent of building the railroads across the country, if you go back to that period of time, in terms of job creation, in terms of the efficiency of which you can then generate more GDP upon. So I am setting up for the next bull cycle by slowly moving into these positions, and I'm just looking past what we have right now. Earnings start this month, next week. We have the central bank meeting at the end of the week, and let's have a look before we run away. Let's have a look at our economic calendar to see what risk events we have for the week coming up. All right, July 4th, US is closed, Canada's open. We have our PMI number. Last was 56.8. Let's see where we end up. Getting into July 5th, Tuesday morning, building permits for Canada. Last was negative 0.6%. We have a kind of the same housing market issue that the U.S. has, although I think some of our markets got a little bit more frothier in terms of price. But we've also had an underinvestment in housing, just like the U.S. has had. So we're kind of parallel in terms of that market. Factory orders, 10 o'clock on July 5th. Forecast is for 0.5. And then mortgage applications, we get that every week. Where's the big ones here? 10 o'clock ISM non-manufacturing PMI. 55.9 previous. The forecast is 54.5. Remember, anything over 50 signifies a growth here. You have the PMI final for June. 51.2 is the forecast, just sitting above the 50-point. FOMC minutes. Let's get to see what was on their minds the last time they met. That's going to be important, and we'll be going over that next week as well. Balance of trade for Canada, it's going to be positive just because of the nature of what we have and what we make and what we export and where the prices of what we export are. I don't anticipate that to be negative. ADP, apparently they're going to discontinue this after this one. I think this is their last one, and they're going to discontinue it for a period of time. They've got a reputation as being the always wrong ADP report. They're going to evaluate their model and reintroduce a new model, but from what last I heard on this one is they're going to discontinue the ADP series for a while, which you may as well, because it always seems to be wrong. Let's keep going here. All the way into Friday, which is the big day. Both Canada and the U.S. have jobs day. Here's non-farm payrolls for the U.S., 270,000. Let's see if it comes in lighter than that. Comes in lighter, that is a recession signal. If it comes in heavier than that, don't expect the Fed to let up. So I don't know how to read that number. If it comes in better, hey, yay for the economy, boo for the central bank. They're just going to hit those rates even more. If it comes in lighter, well, boo for the economy, but, well, maybe that'll slow down the central bank. I don't know. Forecast for unemployment rate, 3.6%. And, you know, the participation rate is the one to look at, I think, because if the participation rate can increase, that speaks to supply, that puts a downward or puts some downward pressure on wages. And then you have some Fed speak. You have Williams here, and I think there were a couple others up here, Bullard and Waller, during the course of the week. But I think the minutes on Wednesday at 2, I think will be a high volatility time period, reading the minutes. And then it's going to be Friday morning all the way to 8:30, and both the Canadian and the U.S. numbers come out at that time. So that's it for this week. I should mention that I'm also going to be doing a midweek video from now on, and the midweek video will be answering some of the questions I get in the comments section under the video. I don't always have time to type out answers because, well, I have other things going on. So I don't have time to hit the comments section. I try to do it when the video first comes out as much as I can, but then I drift away. But some questions are worth answering. So midweek, I'll take a collection of those questions and I'll answer them. Also this week, I will have a video out explaining the reverse repo issue with the central bank. It seems to be getting a lot of press because it's like $2.3 trillion in overnight reverse repos going on. Is that a signal of a problem? So I'll put a video out this week describing that. So if you have some good questions, go ahead and put them in the comments section. I may not answer them directly, but they'll be good to put into the video that I'll do midweek, which will answer some of the really good comment questions, something that we can get more learning out of. I'll answer those on a Wednesday video. And that'll wrap it up.